There's a silent killer destroying the wealth of millions of savers every single day, and most people never see it coming until it's too late. It's not a market crash, not a scam, not a bad investment. It's something far more insidious. Time combined with inflation working against traditional savings accounts. While your bank statement shows your balance growing, your actual purchasing power is quietly evaporating. The average saver thinks they're being responsible by keeping money in savings accounts, but they're actually losing wealth year after year without realizing it. I'm Kyle, and today I'm exposing how time destroys the average saver, the brutal math that banks don't want you to see, why safe savings accounts are actually a trap, and what you need to do differently to protect your wealth. If you've been saving money in a traditional bank account thinking you're doing the right thing, this video will change everything. The numbers don't lie, and they're devastating. Let's break it down. Here's the fundamental problem. Inflation erodes purchasing power faster than most savings accounts pay interest. Right now, the average traditional savings account in the U.S. pays 0.45% interest annually, while inflation has averaged 2.9 to 3.8% over the past few years. That means if you have $10,000 in a typical savings account earning 0.45%, you're gaining $45 per year in interest, but losing $290 to $380 in purchasing power due to inflation. Your real return is negative 2.45% to 3.35% annually. Over 20 years at just 2% inflation, that $10,000 loses one-third of its purchasing power, dropping to $6,700 in real terms. At 3% inflation, it drops to $5,537, nearly half its value gone. Your bank statement still shows $10,000 plus minimal interest, but what you can actually buy with it has been devastated. The psychological trap. People see the nominal number staying stable and think they're safe, but purchasing power is what matters, not account balance. Time doesn't just erode your wealth, it accelerates the destruction exponentially. Let's examine the brutal mathematics. If you save $500 in 2000 for coffee money, that bought approximately 400 cups of coffee at $1.25 each. Today, that same $500 buys about 111 cups at $4.50 each. The account still shows $500, but its real value has vanished. You've lost 72% purchasing power. Here's another example. 50,000 euros in savings 1 year ago, with 3.8% inflation, has a real value of approximately 38,800 euros today. That's 11,200 euros in purchasing power destroyed in just 12 months. The gap between nominal and real returns is where wealth disappears. Most people focus on nominal numbers. I have $50,000 saved, but ignore real value. I can buy $38,800 worth of goods. This cognitive bias allows time to destroy savings silently. Even high-yield savings accounts paying 4 to 5% only barely outpace inflation, generating real returns of 1 to 2% annually, better than traditional accounts, but still far below investment returns. The lesson? Nominal safety creates real danger. Time punishes those who don't understand the difference. Time doesn't erode wealth linearly. It compounds the destruction. A 3% annual inflation rate doesn't just reduce value by 3% per year in isolation. It compounds against previous losses. Year 1, $10,000 becomes $9,700 in real terms. Year 2, that $9,700 becomes $9,409. Year 10, $7,440. Year 20, $5,537. Year 30, $4,120. You've lost 59% purchasing power. But here's where it gets worse. During periods of higher inflation like 2022 to 2023, 7 to 9%, the erosion accelerates dramatically. At 8% inflation, your savings lose nearly half their value in just 9 years. At 10%, half the value disappears in 7 years. The average saver experiences multiple inflationary cycles over a lifetime, some mild, some severe. Those who kept cash during the 1970s and 1980s saw purchasing power decimated as inflation hit double digits. The compound effect means early years of erosion make later years even more devastating because you're losing purchasing power on an already diminished base. Time is the multiplier of financial mistakes. The longer you stay in low-yield savings, the worse the damage becomes.
Here's the paradox. Savings accounts feel safe because they're stable, FDIC insured, and show consistent, nominal growth. Your brain registers $10,000 as $10,000 and feels secure. But this psychological comfort is exactly what enables the destruction. Behavioral finance research shows humans suffer from money illusion. We focus on nominal values instead of real purchasing power. We fear volatility more than we fear silent erosion. A stock portfolio that drops 10% in a year feels scary and triggers action. But a savings account losing 2 to 3% real value annually feels fine because the nominal numbers stay stable. This cognitive bias causes people to avoid investments that would actually protect wealth, stocks, real estate, index funds, in favor of safety that guarantees slow destruction. The trap is reinforced by financial institutions. Banks advertise guaranteed returns and no risk without mentioning purchasing power loss. The result, millions of savers think they're being responsible while time quietly destroys their wealth. The perception of safety is more dangerous than actual risk because it prevents protective action. Beyond direct inflation erosion, there's massive opportunity cost. Money sitting in savings accounts earning 0.45 to 4% could be invested in assets generating 8 to 10% annually. The difference compounds into staggering wealth loss over time. Example, $10,000 in a savings account at 1% grows to $12,202 in 20 years. That same $10,000 in an S&P 500 index fund at 10% grows to $67,275. The difference? $55,073 in lost wealth. Over 30 years, savings account yields $13,478, index fund yields $174,494. Lost opportunity, $161,116. For someone saving $500 per month, the numbers are even more dramatic. Savings account at 1% over 30 years, $209,000. Index fund at 10%, $1,130,000. Difference, $921,000 in lost wealth. That's nearly $1 million sacrificed for the illusion of safety. The average saver doesn't just lose to inflation, they lose the compounding growth that would have protected and multiplied their wealth. Time amplifies this opportunity cost exponentially. Every year spent in low-yield savings is a year of compound growth sacrificed forever. You can't get those years back. Many savers justify keeping money in savings accounts because they're FDIC insured, protected up to $250,000 per account. But here's what FDIC insurance actually protects: nominal dollars, not purchasing power. If you have $100,000 insured and inflation is 3% annually, FDIC guarantees you'll get $100,000 back, but it doesn't guarantee that $100,000 will buy what it does today. After 20 years, your protected $100,000 has the purchasing power of $55,368. You got your nominal dollars back, but lost 44% of your wealth. FDIC insurance protects against bank failure, not inflation destruction. This creates a false sense of security that keeps people trapped in eroding assets. Real wealth protection requires assets that grow faster than inflation: stocks, real estate, inflation-protected securities, commodities. These carry volatility risk, but over long time horizons, 10 to 30 years, they consistently outpace inflation and protect purchasing power. The irony: the risky investments are what actually provide real safety, while the safe savings accounts guarantee real wealth destruction. FDIC insurance is important for emergency funds and short-term needs, but relying on it for long-term wealth preservation is a catastrophic mistake. For retirees and near retirees, the time destruction of savings is especially devastating. Fixed incomes combined with inflation erosion create a financial squeeze. If you retire with $500,000 in savings accounts earning 1 to 2%, while inflation runs 3 to 4%, your purchasing power declines every year. Year 1, $500,000 buys $500,000 of goods. Year 10,
effectively $370,000. Year 20, $274,000. Year 30, $203,000. You've lost 59% purchasing power while the nominal balance stayed roughly flat. This forces retirees to either reduce living standards progressively or deplete principal faster than planned, risking running out of money. Recent Department of Labor research shows 25% of employed adults decreased retirement savings in 2022 due to inflation eroding discretionary income. Many retirees discovered too late that their safe saving strategy has destroyed their financial security. The solution requires shifting to a balanced portfolio generating real returns above inflation. Dividend stocks, real estate investment trusts, inflation-protected bonds. But most traditional savers don't make this shift early enough and time runs out. The psychological attachment to safety becomes a trap that destroys retirement security.
Here's the common pushback. Kyle, I need my money accessible and safe. I can't risk losing it in the market. This objection reveals the fundamental misunderstanding. You're already losing money through inflation erosion. The question isn't whether to risk loss. It's which type of loss you'll accept. Visible volatility or invisible erosion. The solution isn't choosing between savings accounts and risky investments. It's strategic allocation. Keep 3 to 6 months of expenses in high-yield savings, currently 4 to 5% available online, for emergencies and short-term needs. This is your liquidity buffer. Everything beyond that should be invested in diversified assets that outpace inflation, low-cost index funds, real estate, inflation-protected securities. Yes, these fluctuate in value, but over 10-20-year time horizons, they consistently generate real returns above inflation. The volatility you fear is temporary. The inflation erosion is permanent. Short-term market drops recover. Purchasing power lost to inflation never comes back. The real risk isn't volatility, it's running out of money because time destroyed your purchasing power. Reframe the question. Can I afford not to invest? The answer is no. Here's the systematic approach to protect your wealth. Step 1. Calculate your true emergency fund need, 3 to 6 months expenses, and move that amount to a high-yield savings account, 4 to 5% currently available online. Step 2. Everything beyond emergency funds should move to investments. For beginners, start with a diversified index fund like S&P 500 or Total Market Fund, historical 10% annual returns. Step 3. Automate monthly contributions. Consistency compounds faster than timing. Step 4. Rebalance annually to maintain target allocation. Example, 80% stocks, 20% bonds for those under 50. Step 5. Ignore short-term volatility. Focus on 20-30-year purchasing power protection. Step 6. Increase savings rate annually with raises to accelerate wealth building. Step 7. Use tax-advantaged accounts, 401k, IRA, to maximize compound growth. The math is simple. Sacrificing 1 to 2% short-term volatility risk generates 6 to 8% additional real returns long-term. Over 30 years, that difference turns $100,000 into $143,000 savings or $1,744,000 invested. Time can either destroy your wealth or multiply it. The choice is yours. The people who protect wealth from time's erosion share specific habits. They understand the difference between nominal and real returns. They invest surplus cash beyond emergency funds immediately. They maintain discipline during market volatility. They prioritize real returns over nominal stability. They educate themselves continuously on inflation and purchasing power. They automate investing to remove emotion. And they think in decades, not months. These people track net worth in inflation-adjusted terms, not just nominal dollars. They celebrate real wealth growth, not account balance increases. They view short-term market drops as buying opportunities, not threats. They understand that time is either your greatest ally through compound growth or your worst enemy through inflation erosion. And they choose to make it an ally. By age 40, they've built substantial invested wealth, while their peers have safe savings accounts with stagnant real value. By age 60, they're financially independent while others are still working because inflation destroyed their purchasing power. The difference isn't luck or income, It's understanding how time interacts with money and acting accordingly. At the core, time is the ultimate judge of financial decisions. It quietly destroys those who choose nominal safety over real returns, and it powerfully rewards those who embrace compound growth despite short-term volatility. The average saver watches decades pass while inflation silently erodes purchasing power, waking up at retirement to discover their wealth was an illusion. The investor experiences volatility but emerges with real wealth that grows faster than inflation, securing financial freedom. The choice is simple, but not easy. Accept guaranteed slow destruction through safe savings, or accept temporary volatility for long-term wealth protection through investing. Start today. Move surplus savings beyond emergency funds into diversified investments, automate monthly contributions, and commit to 20, 30-year time horizon. Tell me in the comments, how much do you currently have in savings accounts and how much are you investing? Let's protect your wealth from time's quiet destruction together. The power is in your hands. Use it before time runs out.